All right. We are live every Monday, 3 p.m. Pacific Standard Time. I go live answering your questions on mortgage, real estate, finance, anything you really have questions on. I'm happy to answer. I'm going to give you my honest opinion from real life experience, talking to mortgage originators every day, talking to real estate agents every day, talking to consumers every single day. As promised, as the title indicates, I wanted to do this last week, was feeling really crummy. But California Housing Finance Agency, CalHFA, came out with a forgivable equity builder loan. Great program. I made a video on it last week that if you haven't seen it, check out my channel. I think it's the last video I've got up that talks about this program. A couple things I'll mention straight from the start. It's not available to a lot of folks, right? You got to fit in the bucket. You got to make less than 80% of the area median income to qualify. And then with that lower income amount to qualify, you've got to be a first-time buyer and you've got to qualify for whatever house you're looking to buy. I think I might have put it in my video. I've done some math since. If you have next to no debt, you're going to be capped out at about a $400,000 purchase, unless you've got a bunch of extra money to put down. If you've got some debts, some car payments, some student loans, some other stuff, that purchase power is going to be even lower because the debt to income ratio requirements for the FHA version or the conventional version, whichever version you end up going with, are going to have to be met. And so you've got make enough to qualify for something, but don't make too much, because if you make more than about $72,000 a year, you're not going to qualify for the program. So smallish bucket you got to fit in. But if you do fit in that bucket, you buy something for $400,000, you can get 10% of that purchase price, meaning $40,000 going towards down payment and closing costs, or a combination of the two. And every year you stay in that loan, 20% of that $40,000 grant, or 10%, whatever it ends up being if you buy less, is going to be forgiven. So year one, $8,000 is forgiven. Year two, another $8,000. Year three, another $8,000. After 5 years, it's totally forgiven. You got to use CalHFAs first. And like I said, it's combination down payment and closing costs. At least 5% of it has got to go towards down payment, so that the total CLTV is capped at 105%, meaning 95% of the purchase price is borrowed, down payment plus closing costs. You can get into the numbers with myself and my team, with another loan originator and their team. Brokers like myself can broker it through a ton of different wholesale lenders. Direct lenders can offer it wherever they're originating loans at most retail shops. So it's going to be available. This is a California program. Most of these down payment assistance programs are community based or state by state. So your state might have something similar or different. This is all stuff that you're likely to see more and more of. A push to serve the underserved communities, to take some of the funds that are being raised by making investment loans more expensive, by making second home loans more expensive, redistributing, reallocating those funds to serve the underserved or entry level buyers, right? In this case, less than 80% of the area median income. Go ahead and fire away any questions you have on this. The video, I went into detail on some of the requirements, being a first-time home buyer, meeting the credit and income qualifications, which is the biggest thing, right? Having to qualify by making less than 80% of the area median income is where a lot of folks are going to be immediately hard stop. I had somebody reach out to me, hey, I got pre-approved with you. Let me know where we stand. They make $95,000 a year, just don't qualify, right? Other folks maybe are like, oh, hey, I don't make much at all, right? I only make $3,000 a month. Well, while you qualify for the program with the $3,000 a month in income, you don't qualify for much house, right? If you qualify for $125,000 in California, you'd be hard pressed to find an area where you can find a house that cheap. So it's got to be the sweet spot, right? It's got to be $60,000 to $72,000 in income, very little debt, and hopefully, in a part of California where you can buy at that price point, something in a half decent neighborhood where you're not dodging bullets. All right. Any questions at all on that? Feel free to shoot those my way. If you guys want to talk about that program, I'm more than happy to. If you want to talk about other programs, something I will tell you, I found it really, really interesting that me and Mike Zuber probably bounced this idea around at least 6 or 9 months ago, where I said, hey, listen, if we have a supply problem, if we need more inventory to come to the market, why don't we incentivize sellers? Why don't you tell a seller, a mom and pop landlord like myself, if you sell your home to a first-time home buyer, you're excluded from capital gains tax. Make it something to where, like, if a seller is on the fence but isn't going to sell because they don't want to pay property capital gains, okay, make it something to where, like, if they sell to a first-time home buyer, they're excluded from that. I think it was Lawrence Yoon from National Association of Realtors talked about how National Association of Realtors has actually put this forward, try to get something like this passed in Congress to say, hey, let's pass a bill that incentivizes investors to sell. That's a way you can get more inventory for first-time home buyers. You want to make it easier for buyers. You want to make it to where more inventory comes in the market. Incentivize sellers. What a novel freaking concept, right? Like, simple stuff. Simple. Me and Mike Zuber were talking about this 6 or 9 months ago, and it's cool to see that those conversations are being had, because that's a way, like, tax laws are written to incentivize people to do stuff that stimulates the economy. I don't know if people understand that, right? Like, that's why tax laws are written, to do things that keep this thing a churning, right? And so if you write into tax code things that incentivize people to do what you would like them to do, i.e., unload some inventory, put some inventory on the market for only first-time buyers, you can make it that way. You can make it to where it's not that you eliminate capital gains tax for real estate investors selling real estate. No, you only eliminate it for those who are selling to first-time home buyers. And if you want to go a step further, you can make it to where, like, corporations aren't eligible. It's only a mom and pop investor, right, with a net worth of 10 million or less, or whatever you want to make it, right? Like, you can draw the lines however you want. All right. Good evening. Kevin Hawthorne, thanks for joining, brother. Always nice to see you joining. Joey Garessi, what's up, brother? I'm feeling better. Last Monday, I was feeling like death run over twice. If you use a conventional loan, what is the MI factor for a 700 credit score? Happy to run that for you, Tim. You'd have to tell me if it's 5% down, 10% down, 15% down. It's going to be different on all those. And truth be told, it's going to be different for every lender. I can run it at a lender I know has got the most competitive mortgage insurance in the country. And I'll tell you, I can type it in right now as we are speaking. Tim, let's do a sales price of 400. I'm not looking to see if you're typing, but I'm typing in 95%. So 5% down. And I bet you the MI factor is something like 1.4, 1.6. I might be off. Mortgage insurance has gotten so much cheaper. So much cheaper. What? Oh, I was thinking of something different. 0.48. 5% down, 700 score. 0.48, meaning it's $152 on a $380,000 purchase, $380,000 loan, $400K purchase. So 0.48 is your answer, Tim. If you want to do Well, the equity builder program is going to be most case 5% down. So I guess this will be the same answer for you. If you're doing a conventional loan, if you're doing a FHA, it's going to be the same 0.85. 0.85 is the MI factor for FHA at 3.5% down. You could, on this equity builder loan, you could put some of your own money down. So you could get the full 10% towards down payment. You could actually do a 90% loan to value and pay your own closing costs if you had the money for that, right? Some people don't have it, but I heard, there's no limit to how much you could actually contribute. So if you wanted to buy something for $450, but like that is going to put you above, the payment that qualifies debt to income ratio wise, you could go and put down $50,000 plus take their $45,000 of this equity builder program. That's going to be on there like a silent second. So there's no limit to how much you can put down. Hopefully that answered your questions. Did me seeing the Suns crumble make me feel a little bit better about being a Kings fan? You know what though, Joey? I had to watch Luka, who's absolutely phenomenal, knowing that we passed him up in the draft and we drafted Marvin Bagley. So while, it was great to watch the Suns get destroyed, it was sad to watch the Sacramento Kings' hopes and dreams. Like, could have changed our franchise forever. Luka is phenomenal, man. God, I wish we had that guy. All right. I'm with you on providing incentives to sellers to help make first-time buyers more competitive. Yep. Yeah, that's the thing too, is I think you guys did that B of A program. And, you got to know what the box is. You got to know how to qualify for these programs, what the qualifications are, and be able to fit in it. There's folks like you, Joey, that I think go pretty deep into it and educate yourself as a consumer. I think that's important because what you might find, I think you guys used a bank, not knocking banks, but their loan originators aren't always the cream of the crop. You probably knew as much or more about that program than that loan originator did, but you were able to walk through and ultimately close on that because you had done the research as a home buyer, as someone who's looking to get in the market. And so good on you for that. I commend you for getting through that. So if folks would like, fire away questions you have on the market as a whole. I've got some stats that are interesting, just trying to wrap my head around what's going to happen in 2022. I think that's probably the most asked question, right behind rates, right? People always want to know what's going on with rates. I really think that rates are leveling off. We've seen it over the last, call it, couple of weeks, that rates have kind of chilled out, even with future rate hikes on the horizon from the Fed. Even if they raise it 50 basis points next month and 50 the month after and some quarters, even if they get that Fed funds rate to mid threes, I don't think we're going to see mortgage interest rates move much beyond where they're at. They're mid fives. I don't see them getting above 6%. So I think there should be a little bit of chill in the mortgage rates, hopefully a little bit of chill in what has become a really fearful buyer, in what has become a really, I don't know what the right word is, but I sense a lot of, not panic, but uneasiness from buyers. When truth be told, the market that we're heading into right now is one where it's going to be the best market that buyers have seen in 2+ years. right? Probably since 2019, when you're only competing against an offer or two. Where did that stat go? I had a stat. Where did I put it? Ryan Lundquist from Sacramento Appraisal Blog, one of my favorite guys when it comes to real estate stats, put out a poll. I think he did on Instagram, and he wanted to know from agents, who he has a lot of agents following him, how many offers are you seeing on your listings? And it was 0, 1 to 2, 3 to 4, and 5+. And overwhelmingly, response was 1 to 2 offers. 1 to 2 offers, more than half of the people responded 1 to 2 offers, 52%. And then you had second place was 3 to 4 offers with 29%, 5+ offers was 11%, and 0 offers was 8%. Similar survey done 3 to 6 months ago. Don't have it in front of me, but I would imagine it was drastically different, right? A lot more 3 to 4 offers, a lot more 5+ offers, and we're just in a different market, which is a good thing by almost, all measurable metrics. 20% home price appreciation isn't healthy. It feels kind of good short term when you own millions in real estate to watch it go up hundreds of thousands of dollars per year, but over the long term, not sustainable, not something that makes it very pleasurable for home buyers. So we are entering a market where, as a home buyer, you're likely to only be competing against a few offers. As a seller, you're going to have to price your home competitively and at a reasonable price, and not expect it to go pending in the first 2 days every single time, not expect to be sending out multiple counter offers, expect buyers to want to hold on to some of their contingencies, expect a little bit more pickiness on the buy side as inventory ticks up. I think March to April, inventory is always up. So I don't want to confuse seasonality with something that people, if they just looked at one stat, would see as a trend. But Sacramento and surrounding, another Ryan Lundquist stat, when I looked at it for just Sacramento, just El Dorado, maybe Sacramento and surrounding, was a month-on-month 30% increase in inventory, which, when you're at the lowest levels imaginable, 30% uptick isn't as drastic as it sounds. But we're going to see more inventory. We're going to see longer days on market. It's inevitable, which is a good thing. It's something we all should be excited for. Equity Builder Program, Tim, you want to know how long it takes to close? You should be able to close these things in 30 days. I actually reached out to my friend Molly Ellis, who works at CalHFA, and talked to her about all the questions I had. And this was obviously one of them, is how quick can these things close? It's CalHFA's first that you have to put in front of this this grant, this second that goes on there. And she assured me that any good lender should be able to close this thing in under 30 days. No problem. Art T, what's up? Thanks for joining, man. Fire away. Any and all real estate questions. The best of the lives come when people are just firing away questions. If I can, I'll answer every single one. Even the ridiculous ones I like to answer. Jeanette 46, thanks for joining. Good to see you here. How much are appraisals in California going for? I was told $750. Is this correct? It really all depends. You could, a 3-bedroom, 2-bath, 1,600 square feet in the city, you could probably get one done for $550. If it's a larger home, if it's a more rural home, it's going to be more expensive. If you're on 2 acres and you're a mile or an hour from town, an appraiser might charge you $900. $750 doesn't sound unreasonable. It's within, realm of possibility, knowing that like the easiest places to get to and the smallest, easiest places to appraise are going to be on the lower end, which is probably 550. The stuff that's 6,000 square feet or on 4 acres and an hour and 15 minutes from civilization, those are going to be $1,200 and take 3 weeks to get back. So that's my best answer for you there. When do you think we'll see FHFA unveil the first-time home buyer programs that are being funded by those rate increases on second homes investment props? I can tell you, Joey, they're having discussions like as we speak. Like right now, behind closed doors, this is the conversation that's going on. How much money do we have in the coffer? How much are we going to be able to raise in 2022? Where can we impact the most home buyers? How do we structure this program? All of these things are being discussed. They're being discussed with executives from wholesale lenders that I personally know. I've had personal conversations with executives at multiple lenders that say this stuff is in the works. So not the type of guys that blow smoke. I would say you'll see this stuff in Q3 and Q4 of this year. And it'll be interesting to see what comes of it. You know, there's all kinds of interesting stuff coming down the pipe, I think. I still think that it's likely we see a 40-year fixed from Fannie and Freddie, and that might come before the end of the year. I'm seeing lenders, you know, start to look at different equity line products because there's so much home equity out there, and people frankly don't want to refinance out of a 2.675. So yeah, it'll be a year of new products for sure. So keep your eyes and ears open for stuff coming down the pipe, because I'm sure it's coming. Eccentric. To get the 10% grant, I am self-employed, so I am under the national average income of the city I want to purchase. But I also have an S Corp with the W-2, but I still qualify for the grant. Your total income that we would use to qualify you for a loan is what they're going to use. If your income by the lender's calculations, right, like the net income of the S Corp, add in your W-2 income that you pay yourself out of that S Corp as well. If that's $60,000 a year and 80% of the area median income in your area is $72,000, you'd qualify. So I would get with a lender, get yourself pre-approved, see what that looks like. You know, English is so hard. Cross-reference that with like the area you're looking in and what you can buy, right? Because I'm sure there's some people that might look at this and go, oh yeah, this sounds like something I might qualify for. Well, if you do, but then it means that like 350 is your max budget for a purchase, and you live in an area where the houses go between 600,000 and 800,000, then ain't gonna work, right? All right, Joey, great question, brother. Are conventional investment property mortgages still slightly higher than second homes? Or are they pretty even now? They're pretty even. And I haven't done one in a bit. The thing with second homes is you can still put 10% down. So I think that 10% is still like, you know, if you can conserve your capital, people are rocking with that. But let me see. If I put down 25%, I'll tell you right now, Joey, on this 400K purchase, and I did it as an investment property. All right, investment property, 25% down. Let me see where we at. 400K purchase. All right, that one, let's call it 575. Now, let's call it a secondary residence. See where we're at there. See, keep me sharp, Joey, by asking these questions, brother. I don't get to get in here and price every day. No way, dude. Is it exactly the same? Secondary residence. It's literally exactly the same pricing. 1474. 1474. All right. Yeah, 575 cost about half a point. And let me see. 575, half a point. Exactamundo. All right, yeah. That's not every scenario, but for the most part, we'll say it's the same, right? It's on the scenario I ran. You are welcome, Jeanette. I don't even remember the question I answered. Oh, the appraisal one. Yeah. I want to find this thing I had that was talking about give me 1 minute here. Somebody sent me a really cool purchasing power overview. Oh, we got 19 bips better today. Good for us. Actually saw a green day. I told you mortgage rates are stabilizing. I can feel it. I can feel the stabilization. For people that were in the market to buy, it's been a few months where every day you could just count on it going up. Maybe we're stabilizing. Maybe we could take a deep breath. Yeah, see, we're lower than we were last week. Good for us. 5375. Imagine if we dipped below 5%. People would think it was the greatest thing ever. And 2 months ago, they've been yelling at 5%. All right. Purchasing power. Bear with me. I'm going to find this bad boy. All right. I'm going to share my screen. So I think this is an interesting thing to look at. $2,000 mortgage payment. Over here on the left-hand side, back the beginning of January, with a rate of 3.22, you could purchase something for $461,295 and keep your payment at that $2,000 monthly payment. If you want that same payment as we get down here, to mid fives, that's a $351,854 purchase price. 461, that's almost 20%. No, that's more than 20%. It's 110,000. Just chop sueyed. Granted, we've come back. we've come back to 535 maybe. So maybe you're 358, but you're still $100,000 less on purchase power, which is pretty wild to think about how drastic that changed in 4 months. Somebody who was qualified for 460 got $100,000 taken off their pre-approval in the last 4 months. I mean, that's the type of shell shock that we're just now starting to feel. People are just now starting to change their tune and really like back off. Some can't qualify, some are backing off. It's real. Anybody who's saying it's not is lying to themselves or lying to you, one of the two. All right. Thanks, Amir, for putting this together. Whoever sent this to me. I think it's pretty cool. Yeah, $1,250, $1,750, $1,500, and $2,000. I mean, in California, I might even have to up this to, where the $2,500 monthly payment is, or $3,000, because I've got a bunch of folks that, Sacramento's got $2,500, $3,000, $3,500 rents. So a mortgage payment, even at $3,000 to be locked in, is something that's appealing to folks who are trying to stop renting. Rent increases are as wild as they've ever been. All right, Tim Mack. Can you qualify for a higher purchase price if you use an adjusted mortgage versus a fixed term for 5 years? You know what? This is a great question and a myth, right? A lot of folks are like, oh, hey, I'm going to use an adjustable rate mortgage so I can qualify for more. Truth be told, the parameters to qualify on the adjustable rate mortgages are usually more strict, i.e., if you've got a 5-year arm, you have to usually qualify off of not the note rate, but what do they call that rate? After the first adjustment. If let's say that the rate you get on your adjustable is 4.25 and the 30-year fix is 5.25. On a 5-year arm, you've got to qualify off the 625 payment, because that first adjustment after 5 years, it can go up 2%. So you're going to add that to the note rate and qualify off the 6.25. So you're going to qualify for less actually on the adjustable. So while the adjustable makes sense for a lot of folks, especially in the jumbo world where one full percentage point can be $1,000 a month in payment, don't think that it's a tool that's used so that people can qualify for up to 500,000 instead of 400, because lenders take into account that these things adjust, right? And they're not going to allow you to qualify for $100,000 more with an adjustable rate mortgage. I mean, frankly, that would be irresponsible. So just not the case for how those things work. Rightly so, and good that it's that way. All right, what else is going on in the mortgage world? Trying to find something on the 40-year. I swear I was reading something about the 40-year, like Sprout Mortgage, all these mortgage companies coming out with different loan products. They've got a 40-year with a 10-year interest-only period, the IO 40 Advantage. They keep that monthly payment lower. And in this case, like, you would qualify for a little bit more because the monthly payment is lower on the 40-year. What you got to watch out for on these 40-year interest-only programs is if the 30-year fixed is 5.25% and you get a 40-year with 10 years IO interest only, but it's 6%, you might have a payment that's very close to what it would be at the lower interest rate across 30 years. So don't pay $1,900 a month with zero going towards principal instead of paying $2,000 a month with $400 going towards principal, if that makes sense, right? Because that might not be the exact math on how it shakes out, but not always, what it may seem. Those are going to become more popular. I guarantee you that. All the stats that have come out on how much more ARMs are being used are, what is it now? Like 11% of loans being written are adjustable rate mortgages. I think that you're going to see a big push for the 40-year, and those things are going to become popular. I don't know. I'm just guessing now, right? Samit Balls, I saw your question about why the coupon is still at 4% when rates are already above 5%. I'm not the one to speak on that, to be completely honest. I don't want to get into stuff that I'm not an expert on. I would be guessing. Maybe what I'll do is I'll try to do a little bit of research to find out why that coupon is still what's being sold. There's good reason for it. I'm just not the expert to ask about it, right? I'm really like knowledge heavy on the front end of originating and lacking on the back end secondary markets, to be completely honest. I'm just not focused on the back end stuff to speak on it. And so rather than try to BS my way through it, I'll just tell you I don't know a lot about it. Jeb Smith, what's up, my man? Thanks for joining. I appreciate you. I took 1 week off and I feel like I'm rusty. Like I got to get back in the swing of things. Always enjoy watching you and Josh over on your channel, all the stuff you got going on. Man, we are in a market that is a changing. So I'm consuming more content than ever before from my buddy Jeb Smith, from all types of folks all over YouTube's. I'm taking in stuff I don't agree with just to get an opinion from other folks of from the bearish of the bears to the bullish of the bulls. I think I'm probably going to land somewhere in between, but we no doubt know that change is upon us. Somebody like Jeb, who's working in real estate all day, every day. Somebody like me who's working in mortgage all day, every day. Like, you don't have to tell us. You don't have to show us stats. We know by the conversations. We know by, how many offers his listings are getting. We know by how many buyers are getting in a contract and whether those contracts are $50,000 above ask or at asking price, whether we're waiving all contingencies. It's just something that like we're living all day, every day. Oh yeah. Let's jump into this, Jeb. Thoughts on interest rates with the recession coming. I think that this is something that is coming together for our buddy Barry Habib. All his predictions about us going into recession, and then the Fed basically like having to throttle back interest rates to pull us out of a recession. I'll be interested to see how much the Fed can get done before we're officially in a recession. The more the Fed can ramp up 50 basis points next month, 50 basis points the month after, if they can get that Fed funds rate to 3.5% or 4%, then I think the pullback, right, when they start to go back to the monetary policy that pulled interest rates down, the quantitative easing, right? Because right now we're tightening. They went ease, buying up mortgage-backed securities, lowering the Fed funds rate to 0, and that's what pulled interest rates down to 2.5. Now they're going the opposite way. They're letting stuff run off their balance sheet. They're not buying mortgage-backed securities anymore. They're increasing the Fed funds rate. All this stuff that's making interest rates go up, and really like it's already been baked in. 5.5% to 6% is probably where we sit over the next 3 to 6 months, my guess. Even with that Fed funds rate going to 3.5, if we can get there, Jeb, if we can get to 3.5, before the Fed has to reverse course because the country's in a recession and because everybody is going to be screaming, crying, and bleeding. I think that if we can get that high on the Fed funds rate, then we have like 50, 50, 50, 50. We can do like 4 or 5 pullbacks in a row with the Fed funds rate ticking down. They can buy mortgage-backed securities. They can do the quantitative easing like they did before. And I've heard some people say sub 3, which I think is ludicrous. But I'm going to say my personal opinion is that we teeter between 5.5 and 6, whether it's Q3 of this year or Q4, when we start to go back in that quantitative easing cycle and the Fed starts to pull back. Like, I think that it's plausible that we're sub 4% by the end of the year. Nah, that's aggressive, dude. I almost said the end of the year, Q1 next year or Q2. And I'm saying this only because people way smarter than me have spoke on it. And I would think that things wouldn't happen this quick, right? I'm like, man, stuff doesn't just turn that fast. But people way smarter than me. Literally 3 executives from 3 of the biggest wholesale lenders in the country 2 or 3 weeks ago, I sat in a room and listened to them all agree we've got sub 4% interest rates next year. So who am I to argue with the leaders of PRMG and Home Point and UWM? Smarter than me, more connected than me, all the things, right? So interest rates 5.5 to 6% over the next 3 to 6, Jeb. And sometime in Q4, we start to throttle back. In Q1, maybe we're at 4%. That'd be sweet, huh? I think it's good news for people that are buying right now and have a little bit of trepidation around getting into a 5.5% or a 5.25%. If you can afford it now and you qualify and you're comfortable and you say, listen, I'm going to buy this house, $3,600 mortgage payment. I'm paying $3,500 in rent. All the same, right? If you have an opportunity in the future to refinance it to a $3,300 a month payment, and that same rental is going to be $4,000 2 years from now, maybe you buy right now, right? So, yeah, that's my thoughts. Yeah, I mean, you're right, Jeb. It's like one of those things. It's like a double-edged friggin' sword, right? Like, how can we add first-time home buyer programs, adding to demand, pull interest rates back down, adding to the demand? Like, something's got to give on the supply side. Where do we add fuel to that friggin' fire, right? Does Elon just start another company after Twitter that's just a 3D printer of homes that can build them for, cheaper? And then all of a sudden we've got an influx of supply because he can build 100 homes every 24 hours and he starts plopping up markets everywhere. Why has nobody done that, dude? Some type of 3D printer of concrete homes somewhere. Start that up, Jim. G Glover, don't worry for being late. You're allowed to be tardy in this class. We were talking about CalHFA's Home Equity Builder Program. Is that what it's called? 10% grant from the state of California, from CalHFA. If you stay in the home for 5 years, you have to qualify. You've got to make less than 80% of the area median income. So it's not for everybody, but in the areas that I serve most, 86,000 is the area median income. 80% of that's about 72. And you got to make less than that to qualify, but then you also have to make enough to qualify for what you're looking to get. So it's really like $250,000 to $400,000 purchase price is what you should be thinking. And the 400 is like with no debt, right? So really limited in like, this is even coming from somebody who works at CalHFA who I spoke to last week saying, Matt, listen, like this is a pretty small bucket. They got to fit in this bucket. So let people know right away, like The bucket is small. Manny Rodriguez. I would call DSCR about 7%. Here's something that I did the other day, and I think it's probably a good estimate. If 30-year fixed primary is 5-ish, add a percent for investment property stuff, call it 6-ish, and then add another percent for DSCR type stuff, call it 7-ish. 5, 6, and 7. Más o menos. Benjamin Fajardo. All right, Ben. You asked a great question. You are an average home buyer in 2022, and I'm going to speak to you, but I'm going to be speaking to everybody. Please, for the love of all things on this earth, get yourself connected to a lender you like and you trust and work with them pre-approval, offer, and loan. I say this because borrowers get themselves in a frenzy. They get 3 or 4 lenders in a frenzy. And during this 24 to 48 hour period after you've gone into contract, you will be inundated with so much information that you are unable to process. You are going to go with either the best salesperson, the biggest liar, or a combination of the two, right? I had a buyer recently who got pre-approved with me, was talking to his real estate agent's lender, and had been shopping for 6 months, 7 months. Finally went into contract with the pre-approval letter from the lender that he was connected with through his agent. Then contacted me. Hey, Matt, we were connected last October. We kept in touch a little bit, but now I have an accepted offer. What do you got? Went through this kind of thing where we're shopping after the offer gets accepted. Long story short, I show him a product that we have available. We have no problem closing it in 27 days. He's 3 days into a 30-day contract. I'm saving him $210 per month because I'm a quarter better on a $1.3 million loan. His real estate agent, his lender, everybody involved in his side says, listen, it's too late. You can't switch. You've already ordered the appraisal with this other company. I genuinely felt kind of awkward. I had talked to him first back in October, pre-approved him, good relationship. It was actually a referral from somebody. But then he was introduced to another lender through his realtor. Realtor said, hey, let's submit the offer with my lender. He's local. He can help you get the offer accepted. It turned into an awkward situation where I said, listen, if you think it's going to risk you losing this house, go ahead and proceed with this other person. What this guy ended up doing by not choosing the lender beforehand, all he had to do was compare these loans before and then say, Matt versus this guy, Matt's better. He's got a better loan product for me. I'm using Matt. Would have submitted with Matt, offer accepted with Matt, in contract and closed and saved $210 per month. But since he did the shopping afterwards, I wasn't going to be the guy who made more stress in his life and said, you got to use me. You're saving $210 a month. He would have to kind of get into it with the real estate agent, tell this other guy, hey, I found a better deal. This guy was pre-approved with before. It just gets messy. Figure that out before you're submitting offers is what I think you should do. In this case, it was one of those things where I'm the guy that he's shopping with that could have and genuinely should have with a better loan got the deal, but he had ordered the appraisal and he had already been connected, got his offer accepted with that other person's pre-approval letter, which is one thing, right? You're switching on the seller. The seller's not going to like it. The agent is going to feel uneasy that you're working with on the buy side because of all that switching. So a long-winded way of saying, do that beforehand. Because here's the thing. On May 17th, 2022, if you compare my price to somebody else's price, when you get into contract on June 4th, rates will have changed because they change every single day, but mine change and theirs change equally, right? I think you just can shop a loan versus the market and say, you know what, Matt and his team are competitive. They're giving me a great rate. That's who I'm going to work with. Cause you a lot less stress, a lot less, last minute trying to make a financial decision, while truth be told, in that moment when you got accepted offer, you're like the prettiest girl, right? That everyone wants to dance with. They are going to say whatever they need to say to get you on the dance floor, including lying to you, right? Because there's, in a tough market like this, not all loan folks are the up and up. Mark McDonough, what's up? How we doing, buddy? Thanks for stopping by. John Garcia, refinance rates, mid fives, low fives, depending on if you want to pay points. If you got 800 credit score versus a 700, if it's 60% LTV versus 80, all kinds of different stuff, but they in the fives for the most part for the 30-year fixed. I feel most loans have two borrowers, mom and dad. If a recession happens and one of the borrowers becomes laid off, this could cause more inventory by the borrowers having to short sale or foreclose. I mean, it could, but keep in mind, 90%, 95% of the loans out there are 30-year fixed rate loans. People that are in homes right now, the vast majority, have affordable mortgage payments. I don't know how much I'm going to bank on a bunch of short sale foreclosure inventory coming to the market. Even if it does, you're talking about a scenario that's 3, 5, 7 years out. I think so, Isaac. I feel like there's some stuff out there, right? On 3D printed homes. It's a thing that's being at least talked about. You know, at least there's some folks out there that are eyeing this. Gypsy Tree. This is like the average email I get. 805 credit, 10% down, 190 yearly combined household income, 14 years with same employer, looking in SoCal. Thinking about taking a stab. All right. I'll take a stab at this since you're taking a stab. 90% LTV. And let's call it 190 yearly income. 15,000 a month is 180. So what's that? 16,000-ish? 16,000 a month. We'll take 16,000 and we'll say we want for your sake, not even for qualifying sake, let's say 16,000 a month and you want your front end ratio, meaning just the debt, just the mortgage debt compared to your income to be 40%. That's still pretty high. It means you could have a mortgage payment up to $6,400 with 10% down, taxes, insurance, all the things. You are probably in the mid 900s. 855 loan amount. 950 purchase price. 855 loan amount. A 10% down jumbo that's got no. Oh, you know what? You're not even in jumbo. If you're in San Diego County, you're still high balance. Yeah, you're going to be near $1 million if you've got no debt or next to no debt. Got some debt, you're going to be less. But like I tell everybody, this market, no market, is a market to just be eyeballing it. If you're serious about buying, application docs, take 30 minutes of your time and put together an application, submit the supporting docs, get yourself fully pre-approved with a reputable lender. And not only will you be pre-approved and able to submit offers and in a position to do so when you're ready, but you're also going to see, okay, $950 with 10% down, here's what the payment looks like. At $900 with 10% down, here's what it looks like. Then you sit down with your significant other, or, by yourself if you're buying on your own, and kind of figure out, okay, like, do I want to target maybe a lower price where I got a $5,500 a month mortgage payment? Do I want to hire the MAC, go after this? Start to cross-reference that with what's available in the neighborhoods you want to live in. Do you want to live in a smaller house in a better neighborhood, a bigger house in a less desirable neighborhood? All those questions, no use in asking those unless you know exactly what you qualify for. No way to truly know what you qualify for until full app, docs, in with the lender, and then you're in the game, right? If you're not fully pre-approved with a reputable lender, if you just talk to somebody in the call center at Quicken, you're not in the game, right? You're just sitting on the sidelines, just cheering, right? If you want to get in the game, you gotta do the work. So with that, I think it's a good place to end. Thanks for joining, folks. Every Monday at 3 p.m. Pacific Standard Time, I'm going to be here. Last week, I just couldn't bring myself to. I felt like death had run me over twice. So barring any future sickness, I shall be here. Shoot me your questions, concerns, comments, all that good stuff. I'm happy to answer it. Matt, the mortgage guy, thanks for joining, folks. And until next time, we gonna see.